Hey option traders, for today's trade we're looking at a bearish option play in financial stock JPMorgan. Taking a look on MarketSmith, shares have continued to slide below their 50-day moving average, which has been in a downtrend since the end of last year. The stock's clearly been struggling lately as shares show a 32 RS rating out of a best possible 99. JPMorgan is also set to report earnings on Friday, which could lead to a shakeup in the stock. The firm has recently struggled with several quarters of year-over-year earnings declines. This has also hindered the EPS rating, which is now at 66 out of best possible 99. The stock's relative strength line has also been in a downtrend for the last year or so. Weakness in the stock's relative strength line is yet another bearish signal. With the stock below key levels of support and with earnings right around the corner, you could consider putting on a bearish risk-defined strategy known as a bear call spread. A bear call spread is an excellent strategy for beginners and is used when investors expect the underlying stock price to fall. Remember, with options, there are two types. There are calls and there are puts. With both calls and puts, you can either be a buyer or a seller. Just like with any stock, you can either buy long or sell short. A bear call spread is a credit spread, which means that you'll collect a premium up front for initiating the trade. For this trade, we are both buying a call with a given strike price and selling a call with a lower strike simultaneously. Together, they create a spread. Both calls are on the same stock and have the same expiration date, but the difference in strike prices creates a range. The investor can expect a profit or a loss based on where the stock finishes compared to that range upon the option's expiration date. For the bear call spread, we expect the stock to go down between now and the option's expiration. The investor nets a credit for putting on this trade, meaning that you are paid a premium up front. Since calls lose value as the underlying stock falls, both options would expire worthless if the underlying price finishes below the lower call strike. Here, the maximum profit would be achieved, and that would be the initial premium that you received. On the downside, if the stock price moves above the higher strike call option, both call options would have lost money, and the maximum loss for the strategy would be realized. It's important to know your potential gain, loss, and break-even points for the trade. This will depend on the width between the two strike prices of the calls in the spread. For example, buying a 70 call and selling a 65 call creates a spread that's $5 wide. If the bear call spread collects $1 in credit, the maximum gain is $1 times 100 shares of stock each option represents, so the max gain would be $100 if the stock price is below the short call at expiration. The maximum loss would be $400 if the stock price is above the long call at expiration. Take the spread width minus the premium received, and you have your max loss. The break-even point would be the short call strike plus the premium received. Let's talk about a couple rules for taking profits. So first, if the trade has achieved a profit equal to 50% of the premium received, that can be a great time to just take profits and move on to the next trade. This is particularly true if the profit comes in the first half of the trade. On the other hand, when a bear call spread moves against you, don't allow the loss to get bigger than 1.5 to 2 times the premium received. A second rule to consider is rolling a losing trade out in time to the next expiration. The next expiration could be a weekly or a monthly option. The main thing to remember here is that you only want to roll for a credit. Rolling out in time means you're tying up more precious capital for another week or month, so it's essential to receive a net credit for taking the extra risk. Let's take a look at my trading platform and set up this trade. So setting up this trade, first make sure you have JPM as your ticker symbol. In the spread box here, you can select vertical as the spread type if you're using Thinkorswim. And like usual, we have the strike prices down here in the center, and we're going to be looking at this row here, which shows a 111, 112 strike, and we're going to adjust the 112 strike down below. And you're going to want to look at this side of the screen for call prices. To summarize this, we're looking to sell one October 14th, 111 call, and buy one October 14th, 116 call. And you can adjust the specific strikes by clicking this box here on Thinkorswim. So we're looking at selling the October 14th, 111 call, buying the 116 call. Selling these two options generates roughly $70 in premium, and the trade has a max risk of $430. The spread will achieve max profit if the stock closes below 111 on October 14th, in which case the spread would expire worthless and you would keep the $70 option premium. The maximum loss will occur if JPMorgan closes above 116 on October 14th, which would see the premium seller lose $430 on the trade. The break-even point for the bear call spread is 111.70, which is calculated as 111 plus the $70 option premium per contract. Investors should note that there is little room for adjustment with short-term trades such as this held over earnings. Short-term trades also contain assignment risk, so be careful. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment. Be sure to check out investors.com/options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.